Welcome back to the Wall Street Podcast. Today, we're doing a deep dive into a Morgan Stanley Asia Limited research report. It's titled PDD Holdings, Inc. Asia Pacific. 2Q25 Preview Better Positioned EC Play. And it came out just yesterday, August 6, 2025. The core analysis really anticipates a pretty resilient performance for PDD Holdings in Q2 2025.
Yeah, that's right. They're pointing to stability in domestic e-commerce, Temu's losses narrowing quite a bit, and interestingly, better investment income. All this kind of positions PDD well against the competition, or so the report argues.
Okay, so let's break that down. What are the key headline numbers from this 2Q preview?
Well, the forecast is for 17% year-over-year GMV growth, that's gross merchandise volume, and 15% revenue growth.
Pretty solid.
Yes, and importantly, non-GAAP net profit is expected to tick up sequentially. They're pegging it at RMB 19.5 billion. So these figures, they suggest PDD's strategy as well, working.
Right. Let's start with the domestic e-commerce piece. The report mentions PDD kept up subsidies for merchants and consumers, especially around the big 618 festival.
Yeah.
How did that play out with their take rate and marketing spend?
So PDD definitely maintained those subsidies, even increased them for 618. And yeah, that did put some pressure on the take rate. The report notes online marketing service OMS growth was actually slower compared to the GMV growth.
Okay.
And consequently, sales and marketing expenses were higher. But, the spending helps them stay competitive on price. It's part of their value proposition.
Makes sense. And what about Temu, their international platform? The report sees losses narrowing significantly there.
Yes, quite a bit. They project the long down to RMB 1.9 billion in Q2.
Wow. From RMB 3.4 billion in Q1 was behind that improvement.
It seems to be mainly down to lower sales and marketing spending in the U.S. market for Temu. This follows the removal of the de minimis rule.
Right, the duty-free threshold change.
Exactly. So that change might have reduced some costs or perhaps the need for such heavy promotions over there.
Interesting. And beyond the core operations, there's this rebound in interest and investment income. It dropped quite sharply in Q1.
It did, yeah. Dropped to just RMB 223 million from like an average of RMB 5 billion quarterly last year.
Took a big swing.
Huge. But they expect it to bounce back to around RMB 3 billion in Q2. And that's pretty important for the overall profit picture.
How so? Why is that stream so crucial?
Well, it provides a significant cushion, doesn't it? A strong recovery there really helps the bottom line. It means the profit increase isn't just relying on, say, operational improvements alone. It gives them a buffer.
Got it. Okay, let's pull back a bit. We know there's intense competition, Alibaba, JD, Meituan, especially in areas like food delivery and Q-commerce. So how does Morgan Stanley see PDD's position within the broader e-commerce sector against that backdrop?
The report actually suggests that competition in what they call shelf-based e-commerce has become a bit more rational, maybe less of the cutthroat price wars. And that, combined with PDD having a sort of lower base for comparison in the second half of 2025 for both revenue and profit, that actually puts them in a pretty good spot, relatively speaking.
Advantageous position, then.
Yeah.
Now, here's something interesting. Morgan Stanley raised revenue forecasts but lowered earnings estimates for PDD. That seems counterintuitive. What's driving that divergence? Something about Temu's model.
Exactly. It ties back to Temu's shift in the U.S. since July, apparently to what's called a fully entrusted model.
Fully entrusted.
Yeah. Basically, Temu takes on more of the logistics and operations from the merchants. In return, they get a higher take rate, which boosts transaction services revenue. That explains the higher revenue forecast.
But lower profit estimate.
Right, because while the take rate is higher, the margins on that model are actually lower per transaction. So it's a trade-off. More revenue, but less profitable revenue, leading to the lower overall profit estimate.
Understood. So, wrapping up the report's view, what are the key drivers and potential risks for PDD's investment outlook?
Okay, on the upside, the drivers are things like potentially faster user growth if consumers keep leaning towards value. Also, improving unit economics for Temu as it scales, and maybe less competitive heat.
And the risks.
Downside risks include, competition flaring up again and hitting margins. Also, maybe user engagement drops if they pull back on subsidies too much. And then there are always potential regulatory hurdles or just slower than expected expansion for Temu overseas.
Right. It's fascinating how these high-level corporate strategies, the stuff in these reports, really do trickle down. When a company like PDD focuses on value or makes cross-border shopping easier with Temu, that directly impacts you, the consumer. It affects the choices you have, the prices you pay, how you shop every day. these reports reflect those bigger economic shifts.
Absolutely. And maybe a final thought for you listening. Consider how these kinds of strategic shifts by major players like PDD could continue to reshape not just retail, but global trade dynamics and even your own expectations as a consumer in the next few quarters.